Kia ora, and welcome to the CoreLogic Property Market Update for July 2018. Well, the latest round of value data showed values effectively stagnating across the main centres and also slowing down the majority of our provincial centres too, perhaps reflecting a quieter winter as well as the longer term credit-related slowdown continuing. The slowdown has been pretty gradual, and it's mostly because banks are tightening their lending. As volatile as the property market can be, sometimes the history books have a lot to offer. So recently, we analysed previous downturns to better understand where things could go here on in. New Zealand has had 3 downturns in the last 30 years. Firstly in the early 1990s, then in the late 1990s, and then of course the most recent one in the late 2000s. An event caused by the global financial crisis. A mostly unexpected and dramatic shock. And that's probably what we're considering here, an unexpected shock occurring, because in its current state, no one is predicting any sort of significant downturn of the New Zealand property market. But of course, it always pays to be prepared, and data helps us to do that. The actual figures tell the overall story nicely. As we can see in the chart prepared earlier, the first thing to note is that each downturn behaved very differently. The effective loss of value, the time it took to lose that value, and the subsequent recovery were all very different. And this is also true when you look at the charts across the different parts of the country. For me, the most interesting thing here is that none of the downturns saw a loss in value of greater than 10% from peak value. Only those who acted very late in the upcycle would see a paper loss in value, while most others will have brought early enough in the cycle to have experienced capital gains greater than this amount. Therefore, it's less likely that hardship would occur, although that can also depend on other circumstances, including job losses and interest rate increases. Moving on to our other main factor of the day, and that is those earlier mentioned provincial cities, the likes of Whangarei, Rotorua, Napier and New Plymouth, as well as Nelson and Queenstown down south. Both the house price index data and our recently released top and bottom suburbs list illustrate a relative strength outside the main centres. But we believe there's definite reason to be cautious. A key factor illustrated in the Stats New Zealand migration data is that when we see an overall net migration outflow from New Zealand, this is felt more in the provincial centres, especially when the Trans-Tasman balance is in Australia's favour. As it stands, forecasted GDP growth in Australia is tipped to overtake New Zealand, so we are very wary that the worm may be turning across the ditch. But as with many of these things, it's one element to monitor, not one to panic about. Make sure you've got the latest market info by heading to corelogic.co.nz, where you'll find all our recent and up-to-date research pieces, including the latest suburb town analysis, where Little Old Kawerau topped the annual growth chart and the rural Auckland suburb of Parau picked up the wooden spoon. Catch you next month.